Hey, how to avoid 5 common market investing? When it comes to investing in stock markets, people do see make some mistakes, and it's always good to learn from those mistakes. And if you learn from somebody else, it's even better. Regardless of where you are, I'm going to share 5 mistakes to avoid in stock market investing. Step one is not starting early. That is, your time, like when you're in 20s versus when you start 30s or 40s, is very different. So the sooner you start, the sooner it is for better for you. Obviously, you're gonna learn somewhere when you get started, but not starting early is number one mistake. So even if it's very small, start early. That's the number one mistake a lot of people don't do. Except could be if you have very high credit card debt and you want to pay it off because you have very high interest rates. That's one thing. But if you're really interested, I'm sure you could get like $1 or $2,000 and start getting in investing. And if you're even a beginner, you could just start with index funds. Very simple. So start early. That's number one. Number two, believing some big hype. Well, if you're watching these TV shows or something online, I'm sure there are people who make up big hypes. Oh, this is the big thing. Oh, that's the big thing. Well, obviously, there'll always be something next big thing happening in the next 5 years, 10 years, even like next 6 months to a year. But invest in what you understand. Like if you don't understand something, it's new to you, or it's totally out of your subject matter. Just don't go into it. But there are always people who are always hyping things. You falling for hypey stuff can get you burned. So that's number two. Number three, thinking it's easy and it's very simple. Well, it looks like buy, sell, right? It's as simple as that, isn't it? Well, think about playing in a game. I mean, playing a game, isn't it simple? Well, it is a game, like this is also a game. So, in one sense, it looks easy because you're playing a game. But when you're putting your own money into it, that's when your emotions get involved. So, even if you're doing paper trading, like you're not putting your money, but you're just doing a paper trade, your emotions are not involved. So, the way you make a decision, like when to enter, when to exit, is not same because your emotions are tied up. And even you paper trade like small amount versus big amount, they don't match up because only when you put your real money on the down, then your real emotions get involved, and then the investing works. And technically, it's an emotions game. So thinking it's easy is another mistake. But you do can learn. That's a good thing. So if you are doing small stuff, that's good to learn. So if you never started anything, like the number one mistake, that's to remind you to start, just so you can get the feeling of the emotion and how it works, and where you are, how your decision making is. But thinking it's very easy is wrong because this is a crowd. Many people are getting together to do, and obviously there's some very good investments. They make very good returns over the time, and you have to understand trading versus investing and time frames and all these things. There's a lot of to learn, but regardless, thinking it's easy is a mistake. Number four, not having a good time management. Now, why do I say time management? Well, time management is a life skill. It applies in every area of your life, everything, because it's your like what you're doing right now. That's what it's about. So, if you are somebody and you put some small investment, you're looking at it every day, every few hours, then you're putting so much time into it, so much like mental energy, versus like investing for long term versus 5 year versus 10 year term, where you're okay with that because you're doing it for long term and you have some criteria, and then you don't have to look like every day. Maybe you have some plan. You manage your time, like you look at so many times, or you look at some stat like reports and whatnot, and you look at the broader market. There are many different things in this when it comes to that. But like having some kind of time management like is better than like always being looking at it. So that's another thing. You should not get too much time involved. And it's not trading. I'm saying investing. Now they're both different things. If you're going for a short trade, that's another thing. And obviously, if you're going for a short-term trade and you're keeping an eye on it, that's fine. But still, have some sense of time. That's all I'm saying. And taking too much risk. That is, not knowing what you're getting into. That is, you go into investment like a stock or any of them you like, and then you're not sure how much risk you're willing to take. That is, you're hoping for one day getting a big gain but not understanding the downside, and that's the other thing. You should have some idea before you go into a trade, because risk management is a very very important thing in this, and your money management skills, all those come into play. So by understanding the risk you take, what you're taking and what is your downside, That's a mistake you should avoid. That is, if you're really not willing to lose more than this much percent, maybe you can put a stop loss. Now, obviously, it's easier said than done because your emotions are getting involved. But if you are not sure you want to lose more than this much, 30%, 20% of the investment, and you want to protect it for downside, you can put a stop loss, and that's the way to kind of manage your downside. Because obviously, the most important thing is never lose your capital, right? That's the most important thing, because when you lose some capital, you have to work twice as much to get back to where you are, even more sometimes. Like if $100 becomes $50, that means you're losing 50%, but now you need to make back 100% to get back to where you are. That is, you have to work twice the performance. So that's like you're doing twice the work. So that much you get from the market. And obviously, markets are very efficient. So protecting downside also is important. And it depends on where you are, but having some sense of risk, what risk you're willing to take, uh, is an important thing. And you should not take a mistake of just going into something without understanding risk. Hope it's useful. You can review again because sometimes these take a while to get in. You can watch again and hope you learn something.